So welcome to this week's TERP Tuesday. My special guest this week is Brad Bobb of Bobb Financial in Springfield, Illinois. Brad works with federal employees and retirees. Brad, great to have you.
Nice to be here, Andy.
So thanks for joining this week, and thanks for being the recipient of this week's TERP Tuesday shout-out. So in working with your clients, Brad, what are some of the things you see with regards to tax-efficient retirement planning?
There's a couple things in particular that face retirees that I work with, and I would say probably the biggest one is Roth Conversions.
Okay.
So Roth Conversions is something that we look at, I look at with all my clients at least once a year. So what we usually visit it once a year, and sometimes it's a good fit, and sometimes it's not. But some ways that it benefits them are, I'll give you one good example. I have somebody clients that just retired in 2019. So they retired in 2019. One of them is getting a first annuity. The other one is actually going to get a deferred first annuity. So she's not getting her annuity for another 4 years. And neither one are getting Social Security for a number of years. So their only income right now is one spouse's first annuity. And prior to that, they had income north of $200,000 for the household. So they were paying a fair amount of taxes. However, in 2020, their income is going to be something like mid-50s, $55,000 to $60,000. And they have quite a bit saved in savings accounts. So in 2020, they're gonna be able to get all of their income from that first annuity, and then the rest of the money coming from their savings account. Right. So in other words, their income tax bracket is going to be really low in 2020. So right now, what we're looking at is doing a Roth conversion. And really, their tax. You're a tax guy yourself, so. If let's just say that their adjusted gross is around 60,000, you take the standard deduction from that at 24,000, and now their taxable income is like $36,000.
Yeah.
So, which is exceptionally low, right?
That's right. Yeah. That's a great spot. So, and I've heard different names for this, but tax planning window or whatever you want to call it, that period where you stop working, or your wages go away, or wages get significantly reduced if you're starting to work part-time or whatever. You have not yet started pensions, or if you did, only some. You have not yet started Social Security. If you have other commercial annuities, maybe you haven't turned those on yet, whatever. So you have really low taxable income for potentially multiple years, right? If you have the means to live off of other things in the after-tax world, such as cash or regular brokerage accounts, or maybe even Roths, not that you would necessarily want to tap into that if you're going to be converting, but whatever. Now's a great time. We may be in the golden age of Roth conversions, especially if you're in that tax window with low taxable income, because you can really fill up your 10, 12, maybe even get to your 22, possibly 24% tax bracket while you can, because we know these brackets are going up in 2026, if not sooner. And who knows how further down the line, how ugly your taxes may get. So yeah, that's a great time to do some conversions now, if it makes sense.
Sure.
Not everyone.
And for them, it makes a lot of sense. At a minimum, we're going to do a conversion that takes them up to the 22% bracket. So if their adjusted taxable income is $36,000, the 22% bracket starts at 80,250, something like that. So in other words, that's $44,000 that we can convert this year and pay 12% taxes on it.
That's fantastic. And now, when do you do this? What point in the year? Because you really got to kind of nail down an accurate number. Do you wait towards the end of the year to do your conversion planning?
I typically do, yes. Okay. I can't say that we always do that. I mean, every once in a while we have a big market dip, like we had this spring. And then that's a good time to be looking at it, because asset values are depressed. So it makes sense to convert a smaller amount. Yes, typically we'll look at it in late third quarter, fourth quarter. but occasionally we'll do it outside of that time period.
Yeah, especially like March and April, you can get a lot more bang for your conversion buck when stocks are down 20, 30, 40%, right? So
yeah, absolutely.
Yeah.
And then there's a couple other reasons. So I work with a number of people that are going to retire, and they're going to have a FERS annuity. They're going to have possibly a spouse's FERS annuity,
yep,
or pension, and then they're going to have Social Security and spouse's Social Security. So a lot of people I work with are going to have pretty high guaranteed income in retirement.
Yeah.
So they don't necessarily need all the income that their investments and their thrift savings plan are going to produce for them. So the go-to strategy in that situation is normally to just wait, to do nothing. I'll ask when you plan to take distributions from TSP, and the go-to answer is, well, not until I have to, which right now is not until age 72.
Sure.
And you know as well as I do that that's a potential tax bomb waiting to happen.
Yeah.
So, and what I mean by that is it's a good thing that your assets are growing, but as your assets are growing inside of that tax deferred vehicle, so is your tax burden.
Exactly.
So instead of waiting until you are forced to take money out at 72, we will look at converting a little bit of money every year. And one common misconception is if I do a conversion, it all has to be converted. If I have 500,000 there, man, that's going to create a huge tax bill for me, which is true, it would, but you don't have to convert it all. You can convert 10,000, you can convert 100,000.
Sure.
You can convert whatever you want. So we'll look at doing that a little bit every year before they turn age 72. And reasons for that is, one, you're moving it from basically a taxable spot or taxable vehicle at death to an income tax-free one. Right. And then you're also lowering your required minimum distributions at age 72. So now the amount that you're forced to take out is much lower.
That was a great point too about thinking for legacy and inheritance and wealth transfer. So when you die and leave a tax deferred vehicle like an IRA or tax sheltered tax deferred TSP account, the recipient of it is going to have to pay income tax on all of it. Whereas if it's in a Roth style, the recipient will not have to pay tax on any of it. Generally speaking, if you didn't hold the account 5 years, there may be a little bit, but for the most part, there's no tax. So that's a good sort of not just planning for yourself, but planning for your eventual heirs as well, and doing some good maneuvering of Roth conversions to get ahead of that and potentially save your ultimate beneficiaries some tax bill as well. So good point.
Absolutely. And the one thing that you mentioned is tax rates going up. We don't know exactly what tax rates are going to be in the future, but as you said, right now, it looks like in 2026 at a minimum, they're going to be higher. So, right. So just another thought for people to consider when doing conversions.
Yeah. Oh, great points. Anything else? Anything else good you see come up or recommend?
Probably a couple others, but let me ask you, what's one thing that you think retirees can do to minimize their tax burden?
Yeah, sure. So sort of along the same lines, but tax loss harvesting and tax gain harvesting. The big difference between what we just discussed with Roth conversions is you're going from tax deferred IRS buckets to Roth IRS buckets. Now we're talking about the third bucket that we have not yet mentioned, which is just the regular brokerage account world, otherwise known as the taxable brokerage world, brokerage account. So this is probably what most people think of when you just go and buy stock somewhere or whatever. You open up an account, you deposit, your contributions are made with regular after-tax money. You go buy whatever you're going to buy, and then it may be taxable throughout the course of the year. If it throws off interest or if it throws off dividends, that's going to be taxable to you. Capital gains, you have very good control over capital gains, which is when you eventually sell it. If you sell it for more than what you bought it for, that'll be a capital gain. Specifically, gains or positions that are held more than 12 months. When you eventually sell them, they will be called a long-term capital gain. And there's favorable tax treatment to having income in the form of long-term capital gains. Those tax rates are either 0, 15, or 20%, depending on your other levels of taxable income. Most people will generally fall into the 15% bracket, which is really big. Mm-hmm. Starts pretty low, goes up pretty high. But there is a 0% bracket that could potentially be taken advantage of for single tax filers, if your total taxable income, inclusive of these capital gains, is, I think it's $40,000 or less, or maybe right up to $40,000. Any amount of long-term capital gain within that 40,000 bracket will be taxed at zero. So if you have some positions, some stocks you bought, I don't know, some, big household name tech stocks today that you bought 30 years ago, dirt cheap, that are now worth, multiples of what they originally were, you have a lot of long-term gain built up in that. If and when you sell it, yes, it'll probably only be 15-ish% in most cases, but still, that could be a lot. When you're in that tax planning window again, so your other forms of taxable income are really low, and typically that's you stop working, so your wages go away, you do not yet start pension, you do not yet start Social Security. So beginning of the year, you got zero sources of taxable income. You can control where your money comes from, and to the extent you have some of these large built up long-term capital gains, maybe you sell some off and realize it to fill up that $40,000 taxable income bucket where you can have 0% gains on that long-term capital gain. That's
or which is a great point. Or for married couples filing jointly, that's 80,000, right?
It's double, right? Yep.
Yeah.
So that's tax gain harvesting. That's taking advantage of low income years to recognize some gains and pay hopefully zero tax on them.
Yep.
Kind of the other hand is tax loss harvesting, where if you have other gains from whatever reason for the year, you consciously sell positions that are at a loss, and those losses can offset the gains, netting each other out. So you're going to result in less amount of taxable income than you otherwise would have. So why would you sell a loss? Maybe the question. Well, assume it's like a dog of a position you've had and it's done nothing for a handful of years, and it's down and you don't think it's ever coming up. Well, you may not want to sell it just to sell it. You may want to hold on to that loss and then realize it and sell it when you have other gains that would otherwise be taxable. So you now control when you're going to realize that loss. You can pair that loss up against another gain you'd otherwise have. Those two can kind of net each other out. That's tax loss harvesting. Both of those techniques could be good for anybody, but particularly retirees, because especially if you have low income years, as is common with retirees, those are good things to think about.
Sure. And with just makes me think of a couple of things like the couple I just talked about. We talked about Roth Conversions with their low tax bracket this year, but tax gain harvesting is something else they could potentially do. And as long as they stay in that 12% tax bracket, they would pay 0% on capital gains.
Right.
And then with the tax loss harvesting, being able to deduct $3,000 from ordinary income in a year, and then potentially carry over anything in excess of that, always helps.
Exactly. Right.
Get that tax deduction.
And
great point.
Yeah. So one other thing, I think about that people don't often think of as a tax planning tool are things like charitable contributions, charitable deductions. Now, some clients are genuinely charitably inclined and are going to donate regardless, whether or not there's tax help behind it or tax benefit. Other people, charity is not their thing. But, for those who do donate, it doesn't need to be a lot. I know a lot of people who donate a few $1,000 a year. There can still be tax benefits to that. What do you see with regards to charitable giving, and sort of what recommendations do you have or do you come across?
So I see a couple different things. One thing that occasionally I recommend is I call it bunching your taxes. Okay. And that would be basically loading up on your giving in 1 year and then not giving the next year. And doing that since the standard deduction went up so much.
Okay.
But that's one that is probably a discussion for another day. But one thing I'd like to mention in regards to that, I would say the biggest thing that's missed out on a lot of times is people that are giving that are past that required minimum distribution age, or actually past the age of 70 and a half now.
Yeah.
They can do what's called qualified charitable distributions from IRAs. And that money can go, what that involves is money can go directly from their IRA to a charity, and they don't pay any taxes on that.
Yeah.
So it's a great way of taking money from a qualified account and and getting a benefit, it seems like maybe you're not getting a benefit because you're giving it, you're not getting a tax deduction or anything. But what you're doing is you're not pulling it out of that tax deferred account,
Right.
paying taxes on it, and then giving the money. And you're giving less money when you pull it out, right? Because you have to pay taxes on it.
Yeah.
And one reason that's so important is most of my clients that are retired, they're not necessarily itemizing on their taxes. So they're getting no benefit right now. They're getting no benefit tax-wise from gifting to charities, right?
Right.
You know, if you give $10,000 to a charity in a year and your mortgage is paid off, you have no mortgage interest to deduct. You may have your state and local taxes, which if you're in a state like you or I are in, New Jersey or Illinois, can be pretty high. But most often, it doesn't add up to above the $24,400 or $600, whatever the standard deduction is today. So so you don't get any tax benefit by gifting to charities anymore. I shouldn't say never. Most retirees I work with don't. So they can do qualified charitable distributions once they turn age 70 and a half. And that involves money going directly from the IRA to the charity. And that way you're taking money out of it. It can also satisfy your required minimum distributions once you turn age 72. So those people not wanting to take out money or not needing to take out money at age 72, they can take those RMDs and give those directly to a charity.
And that's all tax-free income that stays out of your income altogether, right? That's the beauty of it.
Yep.
And that's how it works. So it takes it right off the top, and it's that much less balance of taxable income you're going to have going forward for future RMDs or future tax or what have you. So that's a great one. Yeah,
exactly. So those, I would say, those are two or three of the most common tax planning strategies that retirees, middle class retirees that I work with can use and take advantage of.
Awesome. Yeah, really good advice. Thanks for your time and thanks for sharing. Those are definitely great tips, and hopefully, industry practitioners like us and clients or non-practitioners alike will take those into heart and hopefully put them into action. Those are great tips. Thank you.
Yep, you're welcome, Andy. Appreciate you joining you. Good conversation. And if you're a federal employee, middle class retiree, hopefully you can take something of what we said here today and implement that.
Yeah. So thank you. And Brad, if people would like to learn more about you and what you do, where can they go?
Name is Brad Bobb. Company is Bobb Financial, BOBB Financial.com. Go to bobbfinancial.com and tell you a lot more about me and what I do.
Awesome. Thank you very much. And thanks for being part of this week's TERP Tuesday.
All right. Thanks for having me, Andy.
Take care. Bye-bye.